Summer is here, and it is in full swing. We are sharing a list, and this time they are all buy the dip options. Here are the top 5 equities to buy in July. Well, July is a curious month for the market. We're coming off the SAS apocalypse implosion from earlier this year. Not only that, but equities have been down because of it. It's a summer trading atmosphere, so it's simply lower activity overall. There's plenty of room for volatility. People are just waiting to see what will happen. But July is coming up now. The Q2 earnings reporting season begins in mid-month and builds momentum toward the end of the month. And I think that will be a trigger for the market. If it's not a real upside stimulus right now, it's at least a trigger for support. I think the AI trade is still going to be forceful. I think we'll see AI spending expand, but also broadening strength in other industries. The story has not yet played out. Labor markets are fairly tight, lots of macro difficulties, but labor data is quite robust. Income and spending have been rather good. So I think, generally speaking, the reporting season will provide fuel for the market. You know, a lot of these stocks have had a very good upside. That's the possibility to make a profit. I think the profit-taking and intermarket rotation have taken a little longer than I and many other investors expected, but I think broadly that tech trade, that AI, is still very much in play. The first is Amprius Technologies. This is not an AI trade now. It's a tech trade. But what's happening now is the same thing I was talking about before with summer trading and between earnings, reporting seasons, and just having some market tension and chance of loss. However, there was a short seller report that came out that kind of generated some concerns, some fair concerns clearly, but ones that I think may be overstated, and that led the stock price to decrease pretty dramatically. But now we're back to what looks like really appealing levels. The market is flowing higher. We are back at the bottom of the channel again, showing support at these crucial levels, and to me, it seems like a pretty excellent entry point. Next catalyst, Q2 fiscal results. We expect to see triple-digit upside, and we repeat that estimate for scaling production, ramping sales, ramping revenue, and the pathway to profitability. Get that, and this stock price may go back to the low 20s, where it was before. Assuming that is another strong report, we should see analyst mood trends firming again, maybe pushing that high-end objective and driving this market up to new highs. Well, its stock price has been volatile over the last 18 months, mostly due to booming expectations about revenue and the path to profitability. So it's an emergent tech company. They went commercial instead of research. They're ramping up capacity now. They're ramping up production. They're driving sales. That's all baked into the earnings expectation. That's leading to large swings up. But those fluctuations also have possibilities for profit taking. And once those peaks are hit, we see a massive downside. But there is an uptick in there. Lows are higher and higher. So what I'm seeing here today is a technical entry point with an expectation of us retesting the prior highs at the very least, if not hitting new highs. That's a worry because that can limit upside and it can really drag the market lower if they decide to start piling in. But there is potential too. Still feel good about this story. Still think the tail is going the way I had intended. So in that, the short interest is fuel for short covering rallies that will help raise the stock over time as these shorts realize there's just too much danger for them. The second stock is Oracle, or ORCL. Oracle's stock price is getting battered on its expenditure intentions, and that's a massive market disconnect. The market is viewing these short-term increases in debt and dilution as signs that Oracle is an upstart tech firm, even though it is actually a blue-chip tech company. So certainly it's taking on debt and diluting shares to build out data centers, but it's not doing this willy-nilly. There is a lot of backlog to fulfill the requirement. So this is a story of execution. Short-term anxieties are reducing the share values a lot at the present. This is a very historic entry opportunity. As Oracle converts that backlog into revenue over time, I expect the share price to recapture its current highs and then move up to set new highs. There is a lot of money, and that's a worry. It's hurting their financial sheet. It's hurting their cash flow. But again, this is not an emerging technology. There is a need for these data centers. In the Oracle and hyperscaler world, there is a need for high-capacity compute. The alternative hyperscaler to the hyperscalers is Oracle. And so that demand is being supported by Google and Microsoft and Amazon AWS, and it has really de-risked the picture. So again, there are near-term issues, but this is really an execution story that will play out over the next 2 to 3 years. They will turn that backlog into revenue next year, sales into cash flow and earnings, and that is going to shift the whole viewpoint. So it's probably going to be about 12 months or so, maybe 18 months, before we start to see aggressive revenue or backlog conversion. But over the following quarters, what I think we're going to start to see happen is 1, the backlog will continue to grow, but 2, we're going to start to get more clarity around when the conversion will start to happen. And that's going to be a bullish catalyst for the market. We could see the stock price meander for the next couple of quarters, but I predict by latest mid-2027, this market will be in a rebound and recovery stage. So I don't think we're going to see a lot of lower stock prices. This stock is trading at about 3 times its 10-year profit expectation, looking at the future right now, which is chump change. With that vision, plus the execution and backlog conversion forecasts, this stock price might grow 400%, 500%, or 600% over the next 5 to 10 years. The third stock on our list is Snowflake, ticker SNOW. The last year has just been this slow grind with Snowflake. They changed chief executives, he injected life into the business, he stimulated growth, and we're seeing that reflected in their results right now. They're speeding up again. They're earning better margins. They're raising guidance across the board, driven by the demand for AI, data handling, data safety, and data processing, and all of that is being reflected in the stock price. Thus, Snowflake is still in a long-term trading range at the moment. Yet the last price action has been this pretty impressive surge to the top of the range. The first time in years we've been able to consolidate at the top end of the range. The AI trade is screaming a continuation signal. This is especially true with Snowflake and inference coming up fast. Expect things to keep speeding up. I think the next earnings reports are going to reaffirm the trend that's in place, which is really good results, better than predicted reacceleration, strong, robust guidance, and help keep that stock price moving higher in the last earnings report. They beat decisively on the top and bottom line, showed solid backlog growth, and presented an impressive outlook that basically reaffirms that the SAS doomsday worries of AI disruption are really overblown. Things may happen down the road, but what's happening now is these well-established software organizations are using AI to drive their company. It's giving utility to its customers. That's driving their own bottom line and demand. This company is in data management. It offers data management, data storage, and data access. All clouds look alike. So what it really does is just give a comprehensive means for enterprises to handle and store their data in ways that are easily accessible but also safe. This is the software part. This is the infrastructure for AI. So Snowflake is providing a software platform that's helping with the data management, the data storage, and the data security, and enabling enterprises to operate in a cross-cloud environment. The trends are really encouraging. Analysts are bumping up their sentiment ratings and price targets. They are now at the upper end of the range. The consensus right now is a fresh long-term high, and the upper end of the range adds roughly 30% to it. And so what I see right now is this market is building up and is ready for another surge. I expect the next earnings report will drive that. All right, so let's move to the fourth stock, and that is Salesforce, symbol CRM. I think Salesforce is being whacked again for no apparent reason. It's not the fastest growing software company, but it is the biggest. So we shouldn't expect it to grow at 30%. It's in the double digits now. It is powered by agentic AI. It strengthens cash flow. It's improving its margins. That's apparent from the buyback program. It's increasing its buyback. It is aggressively buying back stock. So for me, this stock price sell-off is merely its irrationality at this point in time. It is the market looking at fear versus reality. And I think after the summer ends and the summer trading season shifts back to the fall trading season, we will see the market take more of an interest in this company again. Support, and then enter into rebound mode. If you look at our longer-term growth predictions, absolutely, we're looking at constant double-digit earnings growth over the next 5 years. We expect high single-digit growth over the next 5 years. Again, Ford P&E values this stock at a fraction of its long-term outlook. If you think the price-to-earnings ratio is right for this year, which I think is rather low for this company, we're trading at about 11 times earnings. That's about a 60% discount from where it was. Even if that is true, the long-term view is for 100% upside from a 5 times PE to an 11 times PE. If the corporation gets its premium, the upside will be 200%, 300%, or 400%. Salesforce's most recent profits were good. Advancements, rapid growth, double-digit growth. The directing was a bit lackluster. I think that's part of the reason the market didn't really get into it as well as it did. But again, I think that soft guidance creates possibility for a catalyst down the line. The company has been on a roll, gaining momentum with agentic AI, so I would expect a good chance of outperformance in the next couple of quarters. What will happen is hard to say because they have built networks, these software companies. They're far more likely to adopt AI than an AI company coming in and suddenly taking over their business. I thought we hit the bottom earlier this year, but this stock is an example of a stock that's shaping up as a purchase. But sure, it's hard to actually pick when the exact reversal is. So in this scenario, you buy low. Buy a little extra if it goes down. You're going to have to limit yourself. If it gets too far, too low, you want to stop yourself and wait for a better time. Although right now with the stock, it is at a fresh low. It is still kind of floating sideways at this bottom, displaying a lot of possibilities of rebounding. I think this one is still a great moment to jump into. Let's get into the last name on the list, which is Zscaler, ticker ZS. It could be one of the best plays on this list. It is well positioned as a cybersecurity company to thrive in the AI age. The outcomes confirm this position. Meanwhile, the share prices of its competitors have all jumped into triple digits since April, so this one's languishing. A particular company problem, that was it lost some of its key sales leaders, and that caused management to provide some cautious guidance, and that caused the stock price to decline, and it's now wallowing at long-term support levels. Today, what we're seeing is the firm beating guidance without even hiring new sales experts. I think the corp can beat the guidance. I think that when it names its new sales staff, it will be a spark for market confidence to be reignited, help revive the chances for sales growth, and help the turnaround actually take hold. The company has mostly renewed its ratings and maintained its targets, which forecast a very large upside. Now you look at this and you compare it to the other cybersecurity stocks. Most have flown to new all-time highs. If Zscaler follows them, we are looking at a more than 100% upside just to reach the current highs, and then maybe another triple-digit gain beyond that once we break to fresh highs. The institutional ownership is a little modest, but there is a lot of insider ownership. About 60% of the stock is owned by institutions and insiders, but I think the institutions are really supportive of this market down at these levels. More recent data shows them supporting the support below the recent lows. And with that in play and the analyst bullish, I see the market poised for a really rapid return. There are two catalysts here. One is that they get new sales executives, and the other is that they release the next earnings report. One of those will reaffirm the company's ability to grow and sell its goods and help reinvigorate confidence in the market, and that'll get institutions, analysts, and retail purchasers back in the fray. Thanks for watching. Please subscribe to this channel.